help people out and help you out with your interest rates. How long you've had credit history? Sometimes people will do really silly things when they go out and get a mortgage. They close all their credit lines because they think, oh yeah, that makes my credit look bad. No, actually that's the opposite. That is true. You want to keep the credit lines open so you have more credit history. Because if all of a sudden all you only have is, because once you close them, they no longer help your score. They don't help or hurt, right? They don't do anything for you. So now all you have is like one trade line, and it's, bad, you're screwed. Your credit score is going to be horrible. So many times I see this all the time when people do that. All of a sudden it's close, 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 close. Like, why does this guy have a 650 credit score? Like, I see why. He closed every one of his good trade lines, and then he kept the one open that he was late on. I'm like, oh, brutal, you're killing me. Types of credit that you use. You don't want to have like finance company debt, different things like that. Secured credit cards, those are bad trade lines. They actually hurt your credit score. It's better than nothing, I guess, but new credit. So the other thing is that they look at is how many times you've had inquiries. Okay, and the inquiry is like, if I pull your credit, then you go to Kohl's and you want to get a card because you get 10% off. And then you go to Carson's and get another deal there, or Menards or whatever. So each one of those inquiries costs you about 5 points. And then if you do a lot of them, then I don't even know what the factor is on that. When you're getting a mortgage, just so you know, some people are like, oh yeah, don't pull my credit because I just got my credit pulled over at Wells Fargo mortgage. Well, that doesn't matter. I'm telling you right now. If it's done within a 45-day period, it's in the same family, it won't make a difference. The first one will cost you 5 points, the second will cost you nothing. As long as you do it in a 45-day period, you're good to go.
Student loans,
Very good. Yeah, it's good to have student loans. Definitely. Paying them all the time. We have to count. Are you currently in deferment or no?
I just paid it off.
Okay. Are you in deferment or are you making payments? Okay. All right. Because even if it was in deferment, we count the payment against it. So, but it doesn't matter if you. Yeah. No, that's good. Continue to make that monthly payment. That's a good credit reference because they've been open for a while. Okay. Yeah. So that's good. I mean, those are closed-end transactions. So that will continue to report to your bureau. If you have a revolving transaction, like a credit card, it's considered revolving debt. That when you close it, you're done. It's history. Those, when you pay them off, it continues to report on your bureau. So that's a good thing. So how is your credit score used in the mortgage application? Determines the maximum that you can go loan to value. Okay, because when you're going less than 20% down, you have to worry about PMI. So I have to worry about their rules, and I have to worry about the lender's rules, and I have to worry about Fannie Mae and Freddie Mac's rules. But what that happens is they put these things over one layer on top of another over top of another. So in my mind, I'm thinking of 3 different sets of rules for each person. So I know the worst case scenario. And then like for example, we have programs where I go right through Fannie Mae or Freddie Mac, and I just use their rules and I run it through their underwriting system. Everything's good. You put 20% down. You don't have to worry about anything else. Now, if all of a sudden you say, hey Randy, I'd like to go through Wells Fargo. Okay, I can do your loan through Wells Fargo. And then, well, what happened now? I have Fannie Mae's rules, and then I have Wells Fargo's rules. Then you don't put down 20%. Then I have Fannie Mae rules. I have Wells Fargo rules, and I have the PMI rules. So, and then one of the big factors is credit score. Where you're at with your credit score. It also determines your interest rate. The lower your credit score, the higher your interest rate. And I actually put an example here on the next page. This is looking at today's rate as of Friday. So if you put down 10% on a conventional financing, and your credit score was 740 or greater on Friday, your interest rate would have been 3.375. If it was 720 to 739, you're at 3.5. If you're at 700 to 719, you're at 3.625. 680 to 699, 3.75. Under 680 is where you get crushed. You're at 4%. And then 640 to 659, you're 4 1/8 if you get approved. So a lot of times when I run through the underwriting system, a person has a 640 credit score, they might not even get approved through Fannie Mae or Freddie Mac. I'd have to go FHA because the risk usually is too great. They're going to want you to have a ton of income and a ton of assets to get approved at that 640 credit score. whereas FHA is a lot more lenient in that situation.
Randy, I had a question on
Yeah.
credit score. I know some of the bureaus are using a 900-point system versus an 800. What
What happens? Yeah, that's a good point.
Or 1,000. It's 1,000 versus 900.
Right, it's 850 and then 950. So when you go online, have you ever pulled your credit online? You ever done that?
Yeah.
Got your credit score? So what happens is they use a 950 scale. I'm using an 850 scale. So like people say, oh yeah, my credit score is 900. I'm like, okay, you use the one online. So that one's not a good determinant of what your credit score actually is as far as our purposes go. Don't ask me why they use two different scales. It's really silly, but they do. Or if you want to go get your own credit score, and it's free of charge, they have to do this for you for once a year. You go to annualcreditreport.com. Is that where you want? Okay. And then you can get a credit score on there. I think it costs you $7 for the credit score. But you know, you can get the credit bureau free. But if you want to get the score, I think it costs you like $7 to do that. But that's important. Now, I wanted to go through too the do's and the don'ts. I got a handout here. This is really important too. Okay. I've had people really do stupid things. I had a person, you know, last year, the day before his closing, he quit his job. Okay, he quit his job, and he went self-employed. I'm like, dude, that does not work. You know, he couldn't do his loan because what we do is we verify employment the day before your closing. They're going to verify your employment. They're going to pull your credit. They're going to make sure that you didn't go out and jack. I had another guy had inquiries on his credit. And this is after I gave him this thing, right? I told him this stuff. He went out and he was trying to get a new car, and his debt ratio was at like 44.9%, right? And if he gets that new car, he's toast. He would not be approved. I'm like, okay, I don't know, it was Johnny, whatever, I don't know what his name was. Johnny, you know, you cannot get that car. You have to bring that car back to the dealership, and you know what? I don't want you to buy no car. He goes, okay. People do this stuff. It's crazy. So you want to be stable during the mortgage process. You know, do keep paying your bills on time. Do let us know if there's significant changes or new expenses, so that you know. I know, like if people change jobs, that's cool. You can do that. Just don't go from being a W-2 to be self-employed. You're good to go.
What about changing fields of employment?
It doesn't matter.
Oh, it doesn't matter.
No,
What
no.
about children?
I don't care. You can have like 10 children. I don't really care.
Having like, you know,
That comes into play on a VA loan. The children thing. Through conventional, we don't really even ask those questions. Yeah, you're good. But on a VA loan, we have to figure out, yeah, it's very much. I don't know why they know. Because me, you know, I got 5 kids. I know how much it costs to raise a child. It's not cheap, all right? Think about it really long and hard before you're knocking out those kids. Get all the documentation to us on a timely basis. It's really important too, because once you find a home, we run like a time clock. You know, we have to get it done by a particular time. You have contingency dates, like a mortgage contingency date. That's how long you have until you have your loan fully approved. Then you have a mortgage closing date, and we have to meet all those dates. Or else the seller gets nervous. They get kind of nervous that, oh, their loan's not approved yet. What's going on with them? You know, that type of thing. So it's really important we get that. Do tell us about large deposits, okay? You have to be really careful when you're going to buy. Right now, I don't care. As long as it's 60 days before you're closing, your asset sheets are pretty stable. If you're making large deposits today, what they make you do is any deposit over $500, they want to know where it came from. So we have to document that. Okay, so if you get random money, you know, unless it's just your pay, I don't care. But if you get money from you know babysitting the neighbor kids or whatever guys, this little thing going on the side, they want to know where that money's coming from. You get gifts of money, they want to know where that all is. We have to write an explanation for all those things. Okay. Keep a paper trail on any large deposits that are transferred from bank accounts. We have to just see the money going in and out of accounts. Really important.